Good morning, everybody. Today is November 28th, 2023. Happy Tuesday, everybody. I hope you are well. Top story this morning is oil, or at least that will probably be the top story in the next day or so, because the OPEC Plus Joint Ministerial Monitoring Committee is getting underway today, or at least it's supposed to get underway today. It was actually supposed to start a few days ago, but they were having trouble reaching an agreement on whether or not they were going to cut oil output. All year, we've been talking about this tug of war in oil between supply and demand, and how there were just these incredible forces at work in the oil markets. On the supply side, we have these massive, almost 5 million barrels per day worth of production cuts that have come from mostly Saudi Arabia and Russia this year, all about supporting prices. Anytime oil prices dip down into the low 70s or the high 60s this year, we would get a million barrel per day production cut from Saudi Arabia and Russia. And then at the same time, we've also got this demand destruction that is largely being overlooked by the soft landing bros and the financial media. We've seen massive demand destruction for oil as global trade has slowed, factory output has slowed. Summer travel was pretty good this year, but freight certainly is in a recession. We've got bankruptcies going on in the carrier industry. So you've also had a lot of oil demand destruction, and those two have been waging tug of war all year. Now, right now, at this moment, demand is in the driver's seat. We've had a lot of big inventory builds here in the U.S. There's been a lot of surprises, and a lot of people are saying, wow, the economy is slowing more than we're saying, more than we realized, while in the prior sentence, they reiterated their soft landing BS. But we've had this massive demand destruction, and that has been really driving prices for these last few weeks. Now, that could change very quickly if we get another output cut from OPEC Plus over the next few days. So that's an important one to keep an eye on right now. Oil prices right now, West Texas Intermediate is in the low 70s. That's kind of historically been when the Russians and the Saudis would step in and give oil prices a bump. Also, we got new home prices came out yesterday, and new home sales. And once again, new home sales have slowed. And that is, even if you account for seasonality, it looks like it's slowing a little bit. But the big announcement yesterday was the decline in new home prices. Again, this is new homes, not existing homes, but the prices of new homes, the median price has fallen 17.6% since last October. I mean, that's almost bear market territory. Typically, 20% is viewed as the threshold for a bear market in stocks. So we are just a few ticks away from official bear market territory in housing. That's almost a crash any way you look at it, guys. Now, again, that is just new homes, because we've actually got a decent amount of new home supply. We've got about 7.8 months of supply in the new home market, but the existing home market remains frozen. People just can't afford to sell. Well, people can't afford to buy anything else, and so they're not selling the house that they're in. So the sales of existing homes are just frozen in place. And another interesting tidbit that was in this new home sales release is that the average new home price had only declined by 10.4%. The median price, where most transactions take place, had fallen by 17.6%. So that just goes to show you guys that depending on how you report the data, if you want to say one thing, you can use the average. If you want to say something else, you can use the median. You're talking about the same data set, but you paint two very different pictures. And the reason for that discrepancy is that higher interest rates means cash buyers are having a bigger effect on the market as a whole. Where are there more cash buyers? There are more cash buyers at the upper end of the spectrum and the wealthier individuals, where there are higher sale prices. And so as you've got more cash buyers, because interest rates and high mortgage values are pricing people out of the market, well, you're seeing a slower reduction in the average price versus the median. It's one of those peculiarities. I can't even say it this morning. Peculiarities. That's the last one I'm going with, of our housing market today. And lastly, guys, keep an eye on China's banking system. Keep an eye on the Chinese financial system. More and more stories day after day about China's banks and China's shadow banks. We got a few more today. They're starting to worry about what's going on over there. We'll talk about that one. That slow motion train wreck of the China housing collapse that's been going on for years. it is starting to pick up financial steam. We're not just talking about developers. We're starting to hear more about banks and shadow banks. And that's when this thing goes from a housing market correction to an outright economic meltdown. Again, it hasn't happened yet, but we're again seeing early warning signs of that. And with that, why don't we shrink my big melon of a head and see what's going on in the market this morning? Don't forget, guys, if you're new here, hit that like button and subscribe. We do this every morning, so have your coffee with the melon heads as we go through markets. And it looks like we got a little bit more red again today. The S&P 500 is set to open 6 points lower, 0.14% to the downside. The Dow is down also basically flat, negative 4 points on the Dow, essentially unchanged ahead of the opening bell for the Dow. NASDAQ, however, is a little bit deeper in the red, down 24 points or 0.15%. So stocks are down a little bit this morning ahead of the open, but not a whole heck of a lot. The dollar, on the other hand, seems to be falling again. We're currently down 12 basis points on the DXY at 103.06. Are we going to see a 102 handle on the dollar today? That's interesting. And looking over at the bond market, it looks like we got the long end of the yield curve is marginally higher while the short end is marginally lower. The 30-year Treasury, 4.545, that's up 1.2 basis points. The 10 years yielding 4.40, that's up 1.5 basis points. The 2 years at 4.865, up about 1 point, little less than 1 point. And the 1 month is at 5.407, that is down a half of 1 point. Basically unchanged for the 1 month. Now, reverse repo watch, we talked about this one yesterday. It had taken a big step change down 2 days ago. A little bit less of a move yesterday. We actually ticked up by $1.3 billion, $867.22 billion sitting in the reverse repo, currently on pace to reach zero sometime in the middle of February. Still hugging that red line lower as liquidity tightens. Looking over into the commodity space, we've got December gold futures at $2,021. That's up almost $10 this morning, or 0.5% higher. December silver futures at $24.75. That's up another about 6 cents today. A lot of people were expecting a slam yesterday in the silver market. A little bit, we closed off the highs, but all things considered, silver held up pretty well yesterday. Still in the high 24s. Threatening to go into the 25 range. Congratulations to the silver stackers. We've got platinum is up about 1%. Palladium is unchanged. And crude oil, January WTI futures trading at 75.65. That's up about 80 cents this morning, or about 1%. And let's talk about oil, because we got this one in Reuters. This was dated yesterday. OPEC Plus, this was midday yesterday. OPEC Plus looking at deeper oil cuts ahead of Thursday meeting. OPEC Plus is looking at deepening oil production cuts despite its policy meeting being postponed to Thursday amid a quota disagreement between some producers and OPEC Plus sources said on Monday. Several analysts have said they expect OPEC Plus to extend or even deepen supply cuts into next year in order to support prices, which on Monday were trading just above $80 a barrel. They're talking about Brent crude there. That's down from near 98 in late September. An OPEC Plus source said he expected there to be an option for a collective further reduction on Thursday without providing details. OPEC Plus sources said earlier this month that the group was set to consider additional cuts. The Organization of Petroleum Exporting Countries and allies led by Russia, known as OPEC Plus, will begin its online meetings to decide oil output levels at 1,300 on Thursday, according to a draft agenda seen by Reuters. So no word on how much of a cut. They've been doing million barrel per day cuts pretty much all year. We'll see if this is another one. But again, there was no consensus ahead of the meeting. The fact that they've delayed the meeting tells me it's not set in stone that we're going to get another production cut. But this is the story to watch if you're trading in the oil prices over the next couple of days. And just taking a look here at oil prices, guys, you can kind of see we've had this floor in the high 60s, mid 60s all year long here. I probably drew that line a little bit low, but yeah, you get what I'm saying here. Yeah, that's a little bit better of a floor. We had this peak here. This was after the outbreak of hostilities in the Middle East. And then oil prices have pretty much fallen ever since that initial run-up. Again, demand destruction has been in the driver's seat. But you can see we've been talking about demand destruction for pretty much the rest of the year. Remember, we were coming down here, there was demand destruction, and then everybody was like, oh, the China reopening, it's going to be glorious. Nope, that was a dud. Oil prices fell again. And then we had a oil production cut, prices rallied, and then demand destruction came back. Everybody was worried about that. Oil prices fell. We had more production cuts, and then prices rallied on fears of an oil supply deficit after all the production cuts. But then once again, demand destruction took over, and that leads us to where we are today. So we'll see if we get another production cut this week. Now let's talk about new home sales. This was a big one yesterday, guys. Watch that housing market. Again, it's been frozen in place. It still is frozen in place. At least the existing home sales market is frozen in place, but the new home sales of new single-family houses in the U.S. fell by 5.6% to a seasonally adjusted annualized rate of 679,000 in October of 2023, well below forecasts of 723,000 as the highest mortgage rates in 2 decades weigh on buyers' affordability. And this is the important thing here, is this part highlighted the prices. The median price of new houses sold was $409,300, while the average sales price was $487,000. That's compared to $496,800 and $543,300 respectively a year ago. So we're looking at a 17.6% reduction in the median price of a new home over the last year, and a 10.4% reduction in the average price of a new home over the last year. Again, that is cash buyers on the wealthier end of the spectrum skewing the average higher, but still, even there, you can't hide it. Big reductions in new home prices. And more importantly, at the end of October, there was 439,000 houses remaining for sale, equivalent to a 7.8 month supply at the current sales rate. Now, months of supply, that's an important indicator. 6 months is generally the cutoff. If there is more than 6 months of supply, you're probably looking at a buyer's market with prices heading lower. If there is less than 6 months of supply, then it is a seller's market with prices probably still headed higher. Now, the interesting thing is I saw this one. This is from Eric Basmajian, who put this one out. He is at EPB Research on Twitter or X. I highly recommend you follow him. He puts out great stuff. And he put out this longer thread on the new home sales that came out yesterday. This chart here is taken from the middle of that thread because this is important. The line in blue is the months of supply of existing homes, and the line in black is the months of supply of new homes. And this is kind of important in this chart. Do you see how these two for years here, this data goes back to 1990, how they kind of moved in tandem? It's not a perfect correlation, but when one goes up, the other tends to go down, go up. When one goes down, the other goes down. They tend to move in lockstep. And you notice that all started changing. Really, we saw a diversion around 2015 is when we saw this start to diverge a little bit. And then, of course, with the onset of the pandemic, this gap just exploded higher. And now we're looking at 7.8 months of supply of new homes on the market. So we're oversupplied on new homes, believe it or not. 6 months is generally considered the break-even point. But look at existing sales, only 3.6 months of supply. That's the thing, guys. Your house is not going to go down. If you're looking at buying a house, it's not going to get significantly cheaper until we see this months of supply get back up above 6 months. So for now, the existing home sale market, it remains frozen in place. And I've been saying it for over a year now. The missing ingredient to a full-scale housing crash is higher unemployment. We just don't have it yet. Unemployment is ticking up very slowly, but nowhere near the levels we need to get a massive correction in home values. So for the time being, homes remain unaffordable for most people. Existing homes with prices at all-time highs and interest rates at multi-decade highs. Most people, the average buyer, has been priced out of this market. New home sales are coming back to earth. Existing is still got a long way to go. Thanks again to Eric Basmajian for putting that one out. Now let's talk about China's housing price crisis here. China's property lifeline exposes banks to big losses and job cuts. Risky developer loans threaten to erode bank credit quality, and banks are weighing lower profit targets and job cuts in response. You've got this movement in the CCP right now among the party leaders in China to just basically take this massive housing bubble, this massive collapse that's coming, and just say, banks, you pay for it. And I get it. There's kind of that, class warfare, big guy versus little guy thing that makes you want to say, yeah, man, make the banks pay for it. I get that. I mean, the banks cause these problems. They should pay for it. But let's also remember, guys, that if the banks blow up, oh, crap, they've got all our money. So they take us down with them. So this idea in China, yeah, we're just going to let the banks pay for it. Not sure you guys have really thought this one through. China's escalating push to have its banking behemoths backstop struggling property firms is adding to a maelstrom of woes for the $57 trillion sector. That's a lot. That's a big sector, $57 trillion. Already stung by soaring bad loans and record low net interest. Lenders such as the Industrial and Commercial Bank of China may soon be asked for the first time to provide unsecured loans to developers, many of whom are in default or teetering on the brink of collapsing. And that's a pretty profound statement right there, saying that these banks will be asked, and when the government asks, they don't ask. They're basically ordering to provide unsecured loans to developers who are already in default and on the brink of collapse. In other words, the banks are just going to be told, set your own money on fire and bail out the developers, or else. It looks like that's what's coming in China. The risky lifeline threatens to exacerbate an already bleak outlook. ICBC and 10 other major banks may next year need to set aside an additional $89 billion for bad real estate debt, or 21% of pre-provision profits in 2024, according to Bloomberg Intelligence. Lenders are now weighing lowering growth targets and cutting jobs among possible options, according to at least a dozen bankers who asked not to be named discussing internal matters because nobody names their sources anymore. The government can't just ask banks to step up without providing a solution to their issues, says Shen Meng. They just did. I'm pretty sure that's what they already did. Their profits may still look good on the surface, but if you take a deeper dive into their assets and bad loans, things won't look good for long. And what Shen Meng is getting at there is saying, hey, it looks great, fine, have the banks pay for it. But then when you look underneath the hood at what the banks are holding, the loans on the bank's books, the assets that the banks own, the banks aren't much better off than these developers are. Certainly, if the banks here in the States aren't really that well off, see also Bank of America and their, $133 billion pile of unrealized losses. You've got similar things going on in China with real estate debt. If you just start ordering the banks to start making these unsecured loans to failing firms, guess what? The banks are going to start failing. And it looks like that is the preferred chain of events, according to the Chinese Communist Party at the moment. And that may be getting here sooner than possible. Remember last week, guys, we talked about Zhongji, one of the largest shadow banks in China. It's not really a bank. It's not regulated by a bank. It's just kind of this financial firm where they gather wealthy individuals' money together, and then they go and they make high-interest, risky loans, and they call it wealth management products. But it's a bank. It's not regulated like a bank, but it's basically a bank. It's just a really poorly run bank. Well, they're hopelessly insolvent. And it looks like already people are going to start disappearing over there because China opens probes into troubled shadow banking giant Zhongji. Criminal mandatory measures are taken against multiple suspects. Privately owned wealth managers said it is severely insolvent. So it looks like the Chinese cops were just like, go arrest somebody. And they're like, arrest who? I don't care. Get a bunch of them. We got to show the people that we're doing something about the crooks, which I'll be honest with you, after watching the crooks in the States get away with things for years, I'd entertain the possibility. I'm just saying I'm not endorsing the way the CCP disappears people, but Jesus, do something. Chinese authorities said they recently opened criminal investigations into the money management business of Zhongji Enterprise Company, days after the embattled shadow banking giant revealed a shortfall of $36.4 billion in its balance sheet. That is more than double their assets. Police in Beijing said in a statement on WeChat that they took criminal mandatory measures against multiple suspects, identifying one by the last name of Zhe. They urged investors to report cases or provide leads to the authorities, including filing complaints online. Zhe Zhikun, pardon my pronunciation here, guys, the group's founder, died in 2021, but several of his relatives are currently executives at the company. The statement didn't elaborate on what the measures entail or what crimes they may have committed. So we've got this major Chinese shadow bank. They are hopelessly insolvent. They're going bankrupt. It's just a matter of time. And they started rounding up the owner's family. That's wonderful. Moving on, guys, we got this one from UBS today. They're making a warning about private credit. Keep an eye on this one because as banks stop lending, you've got a lot of other companies are stepping into the bank's roles to expand their business by making these risky loans. They're starting to worry that might be forming a whole new bubble. UBS Chair Kelleher warns bubble is forming in private credit. Kelleher is the latest executive to warn about the rising risks. Private credit market has roughly tripled in size since 2015. That is a lot of growth in a very short time. UBS chairman Colm Kelleher warned against growing risks in private credit as the market continues to boom. There's clearly an asset bubble going on in the asset class, Kelleher said at the FT Global Banking Summit in London on Tuesday. What it needs is just one thing to trigger a fiduciary crisis. Fiduciary crisis is kind of strong words. That's when they're in a hopeless position and they decide, who do we have to screw? Probably the people who gave us their money for safekeeping. That's who we're going to screw over. That is a fiduciary crisis. Private credit has become an increasingly sought-after funding tool for buyout firms as banks have pulled back amid a spike in interest rates and a drop in investor risk appetite. Some banks are concerned about this shift as underwriting these types of loans and then selling them to other investors is a strong source of revenue for them. Kelleher is the latest top executive to warn about the rising risks. PIMCO executives said earlier this month that the market is underregulated and lacks transparency. So again, you got these kind of shadow banks. They're not quite banks. They're not regulated like banks, but they're doing bank business. They're doing banky things. And people are saying, hey, there's a lot of risk starting to pile up here, guys. Is anybody looking? Apparently the answer is not really. And last but not least, guys, let's talk about Cyber Monday because Americans continue to rack up debt to buy stuff that they don't really need. Today is no exception. Cyber Monday forecast boosted after record online holiday sales. Chinese upstart Temu sees big gain in transaction size, and buy now, pay later credit promotions help drive sales because we just love spending money we don't have here in America. U.S. shoppers will spend as much as $12.4 billion online during Cyber Monday, according to Adobe, which adjusted its initial forecast of $12 billion upward based on stronger than expected spending on Black Friday and the popularity of buy now, pay later features that let shoppers stretch their budgets with credit. That's one way to put it. It lets people stretch their budgets with credit. Another way to put it is it lets shoppers buy things they can't afford. I suspect a large percentage of them are saying buy now, pay never, because one thing we've learned is that Gen Z has a big habit of taking out loans that they have zero intention of ever paying back. I guess it's not a problem until the music stops. Then we all say, how could we let this happen? And I just want to say thank you so much to Mr. Dan Hedin. Thank you, Dan, very much, sir. He says 2 houses on our street sold this month and looked like there was a bidding war, listed in the 275-ish range and sold close to 300. Well, Dan, congratulations to those sellers. I was on the proper end of a bidding war when I sold my house back in New Jersey a few years ago. It was kind of nice to sell for several grand above asking price within a few hours of putting your house on the market. So it looks like there's still some of that going on in the market. Again, that existing home sales, recall that chart here. Let me bring it back up. Remember that chart that I put up showing the months of supply in existing homes. This one here. All right, that blue line, that's the thing there. There's only about 3.5 months of supply in existing homes. And so you're still getting those bidding wars for the existing home sales. There's just not enough supply to meet even the few buyers that we have. So we need that number to come up in order for these bidding wars to stop, in order for existing home sales to start falling. Also keep in mind, guys, real estate, there's a lot of regionality to that. Every market is different. So when we're talking about house prices, we're talking about national averages and medians here with the understanding that every individual market is radically different. So thank you for that data point, Dan. And again, you need more inventory in that existing market to really get those existing home prices to come down and those bidding wars to stop. Thank you, sir, for the support of the channel. And thank you, Easy Fix, who says, could the Black Friday numbers just be due to inflation? They could be, Easy Fix, and they almost certainly are partially due to inflation. Although what I've seen so far, assuming the data is correct, all right, so now we're talking, this is private sector data. You know, Adobe is putting this stuff out, Salesforce, Shopify. So the numbers that we've seen, high single-digit year-over-year growth, I'm inclined to believe these numbers. I think some of this, probably half of this growth is due to inflation. You know, the nominal price of the stuff being bought rising. I think 3, maybe 4% of that is probably inflation related. But also keep in mind, inflation this year has been more in form of energy, in the form of housing, in the form of services. We haven't seen a lot of inflation in things like electronics and things like home goods, and apparel has been at least muted. So a lot of the stuff that's selling right now is categories where the inflation has been pretty low for the last year or so. So I think a lot of this actually is more sales growth, but the asterisk there is that it's debt. It's people weighing on this buy now, pay later. It's people running up their credit cards that they already can't afford to pay back. So yes, inflation is playing a role here. It's a contributing factor, but it doesn't explain the whole thing. I think inflation plus debt, now you've got a pretty good picture of what's going on with the consumer. And it also means in the first quarter, when Christmas is behind us and everybody the hangover wears off and everybody steps on the scale, and then they look at their bank statement, their credit card statement, they're going to say, oh crap, we are screwed. That is what's coming in the first quarter of 2024, along with a healthy dose of soft landing narrative courtesy of the financial press. Thank you, Easy Fix. I appreciate the super chat and the support of the channel. Thank you, everybody, for spending your morning with the Mill and Heads here and having your coffee on the morning update live. Thank you to my Patreon supporters for everything you guys do for the channel. Looking forward to talking to you guys tomorrow on our weekly Zoom call. I will be posting that in the Patreon feed momentarily. Links down below to all that good stuff should you feel so inclined. Hi, Mom. Hi, Dad. I love you guys. Until next time, live small and dream big.